Worries.
Hey guys, this is Bobby again with Growthview Properties, and today I'm with our guest Axel Ragnarsson. He's the founder of Aligned Real Estate Partners and the host of the Multifamily Wealth Podcast. Thank you for being here with us today, Axel.
Absolutely. Thanks for having me.
Yes, sir. Well, let's dive right in. I'd love to learn a little bit just about your story and your background to kind of set the tone for what we're going to be talking about today.
Yeah, absolutely. So without being too long-winded, I'll try and give the spark notes here, but currently live in Boston, Massachusetts. I grew up in Southern New Hampshire, about an hour north of Boston. Parents were business owners, entrepreneurs, not really in real estate. They actually sold wood grinders and wood chippers. So totally unrelated to real estate, but I was exposed to business ownership kind of at an early age. And as a result of that, always been really entrepreneurial, bought and sold stuff online, really anything, golf carts or golf clubs, I should say, electronics, all these different things to make a buck up until college. And in college, I started flipping cars, and that was kind of my side business for a couple of years. And after a couple of years of running that, I started to realize that, this isn't really like a long-term plan. And I wanted to figure out what else I could buy and sell, or another business I could start that, is something that I could do after college. So started looking up just really anything that could be flipped that was more expensive than cars. And that's how I stumbled upon real estate, and specifically flipping houses. So I found BiggerPockets and a lot of other real estate investing sites and resources and podcasts, and just started learning a ton about real estate investing. And as I started learning more about real estate in general, my focus shifted from trying to flip houses to multifamily real estate and rental real estate. I was really compelled by the idea that you could kind of do the work once and get paid forever. And the whole concept of passive income was really interesting to me. So eventually shifted my focus away from trying to flip houses and started looking for multifamily deals, small multifamily. Did a few small deals in college, 2 to 4 unit multifamily deals. And after I graduated, started doing that full time, really just looking for deals, and organically grew a portfolio that eventually, kind of paid me a median salary, right? Something that I could pay my rent with and live off of. And it took me a few years to get there, 3-4 years. And then really after that, I started to think about how can I do larger deals, larger multifamily deals? How can I raise money to go do larger deals? And I started trying to think about how I could scale the business a little bit more intentionally. And in the last couple of years, that's really what we've been doing, where we've been raising capital from limited partners and passive investors who want to invest in real estate but don't want to go through the headache of finding deals, managing deals, putting together the financing, all of that fun stuff. And we give those opportunities, or we give those folks an opportunity to invest in our deals. So we've expanded into some new markets. We started buying larger deals. So now we buy deals up in New Hampshire, in Indianapolis, and in Central Florida, as well as a couple of other markets we're looking at. But business has grown quite a bit, and now we really exclusively look at large multifamily projects, and we work with partners and limited partners and investors to buy those deals. And that brings us up to today, I think.
I love it. That's awesome. Sounds like you kind of went through what a lot of people do. You start flipping, you realize, man, this is a lot of work for a big check, and then shifting to commercial. So I love talking about this stuff. That's awesome. So let's start at square one, like how you got into flipping. You started with cars and then wanted to do some bigger checks, it sounds like. Tell me about maybe some just flipping experience that you've had. Like, what are the lessons you've learned? Any tips for people that are getting into that?
Yeah, absolutely. In reality, I was awful at flipping houses. I think I did 2 or 3 before I was like, this just isn't for me. And the reality is that it's a job. It's not passive. You're buying yourself a job, and you can make a lot of money, and people make like really good flippers and wholesalers and folks that are in the transactional side of real estate. They make a lot of money if they're really good at it and they excel. And it's not a bad business to be in if you can excel at it, but my skill set just didn't align with it. I wasn't local to the markets I was flipping in. I wasn't great at micromanaging contractors. Like, that wasn't something that I enjoyed. Yeah. I have a good mind for operations, and I'm a partner in a property management company now, and I asset manage a lot of our deals, but it's a different skill set than going to the property and talking about countertops. Like, now I'm great at the asset management level and managing the property managers and managing a budget and all of that. But that skill set doesn't necessarily translate to flipping houses. And truly, I wanted something that was a little bit more passive and a little bit more tax advantaged. Flipping houses is not tax advantaged. You're taxed at ordinary income rates. So again, it's still a job. And there are so many tax advantages to investing in income producing real estate, whether it's multifamily or some other asset class that make it much more attractive. And I, again, the goal is to build passive income. I didn't want to just, make the 20, 30, 40 grand or whatever it was in a house flip and then be like, all right, well, now I just have to go do that again. So it just wasn't really for me. And I ended up doing a couple of deals that just didn't really go that well. And then I shifted my focus to multifamily and gained, significantly more traction on that side of the business than on the flipping side.
Yeah. What were maybe the three biggest headaches from flipping that just did not carry over to commercial that people should know and understand?
That's interesting. So I think, one of them just that I could think of right off the top of my head is the insanely higher time commitment required to run a flipping business. If you were running a flipping business, you have to excel at a number of different things. You have to excel at finding deals and going direct to seller or whatever strategies you're using to find deals, which for most house flippers is going direct to seller. And that's really how you fundamentally find really discounted deals. You have to really excel at that. You have to really excel at project management and managing contractors, crews, renovations, all of those different things. And you have to basically excel at both those things at the same time, which is really tough. They're two very conflicting skill sets. One's sales and marketing, and the other one's operations. So I had a great sales and marketing, background in terms of what I did and what I like to do. And we did a bunch of direct to seller to find multifamily, and we still do. And I also have an operations background, but it's not in babysitting, which is fundamentally what managing contractors is. It's babysitting. So I didn't want to be the babysitter. I wanted to work with smart people that knew what they were doing. That, for example, our property management companies are great at what they do in the markets we operate in. And my job is a biweekly call where I hold them accountable and I manage budgets and I manage project timelines, but I'm not nagging contractors to nag their electrician to go get a job done. Like that's not my job description anymore. And the other piece of it is it's transactional. You finish a house flip, you got to go do another one if you want to keep making money. With multifamily, you can do a deal, and sure, if you want to continue building your passive income and making more money, you should go do another deal. But you still have predictable income coming in. It's much more advantaged in that respect, and less like a job and more like an actual investment or a business with recurring revenue. So that's what enticed me, about commercial real estate fundamentally, whether it was multifamily or something else. That for that reason, I think it makes just a lot more sense if your skill sets align to that side of the business.
Yeah, that's a great explanation. Now, you mentioned when it comes to flipping, you need to be good at finding off-market deals. I know there's a lot of commercial deals that get done, like for my personal investing, where especially like with mobile home parks, doing a lot of reach out to mom and pops and maybe smaller multifamily that these big institutions are not going after. How were you able to translate the skills you learned from getting off-market deals from the few deals you did on flipping and moving that into commercial to get the ball rolling for your career?
Yeah. And just to kind of mention it again, I really don't have too much of a flipping background. I mean, I did like 3, my first couple of years in the business. Right. And those deals honestly came through wholesalers and auctions. So I didn't even do a lot of direct to seller to like homeowners. That was a very short-lived part of my career. So I really got into direct to seller as it relates to multifamily. And so, I'll speak to what I do, and it's probably pretty similar to what folks do on the direct to seller side that are flipping or reaching out to homeowners. But I think the key difference is in the messaging. So obviously you have a different list. You're reaching out to multifamily properties. You probably filter it a little bit differently. There's less filters than a homeowner list would have for a house flipper, most likely. But I think the key difference is the messaging. And when we send direct mail or we cold email or cold call owners, basically what we're saying is, hey, I'm an investor in this area, in this city. We own a portfolio of multifamily properties and we're looking to buy more. Would love to talk to you about selling your property, but if you're not interested in selling, completely understand. We would love to just network with another owner in the marketplace, and maybe there's an opportunity for us to work together in the future. So it's much less transactional than, hey, we'll buy your place for cash. Like that doesn't hit on the multifamily side. The owners are more sophisticated. They're less motivated. They're not motivated by financial distress. Oftentimes, they're usually motivated by, I'm getting old. I don't want to manage this anymore. Or, this is too small for what I, typically buy at this stage. So now I'm looking to offload my smaller stuff, or I want to roll this cash into a 1031 and buy something else. But it's not like foreclosure, which is usually on the homeowner side. What is a motivating factor? It's like, divorce, death, home foreclosures, really life events are driving those decisions. Around multifamily, it's a little less like that. You can find some distress with partner dissension, which is something that we found, discontent among partners. You can find some inherited properties as well, kids that inherit a property from their dad who was a landlord and owned a few buildings, they want to sell. But it's much more so you're building a relationship with the seller at a personal level. And then you're ideally someone they call when it comes time for them to sell. And these relationships takes months to build. So it's significantly less transactional than on the single family side, from my perspective. And the messaging has to reflect that. It has to reflect, I'm here to build a relationship with you. I'm here to get to know you. I'm not here to try and pitch you on a quick close or a cash deal, because that's not really moving the needle for these sellers. That's not striking them where it hits. So I think that's the key difference is, outside of the list and some of the filtering components is, you want to be a little less transactional in your outreach and more focused on them and building a relationship.
Yeah, I think that's a great point. I hear that often, how, some people are married to these assets. They've been kind of what's brought cash to the family for a long time, or maybe they need to find the right time to exit due to a 1031, maybe looking for something else. So I think that's a good breakdown between the two. Now, the deals you're doing right now, you mentioned you're in New Hampshire, working in that area. Is that right?
Yeah, so I grew up in New Hampshire. I live in Boston now. So, a market that we buy in is about an hour north of Boston. So, that's my quote unquote, local market. If you define an hour away as local, which I think I do. So that's one of the markets that we're buying in. Yep.
Nice. I know a lot of people, they focus and you hear really commonly like the Midwest. I know you mentioned Indianapolis and the Southeast, Texas, a lot of these, like, tell us about New Hampshire. I just know that's not an area you often hear about for people that are syndicating deals. So I'd love to get some of your insights in that area.
Yeah, absolutely. So you're right. I mean, I host a podcast as well, and everyone seems like they're buying deals in Southeast, Midwest, and there's reasons for it. The fundamentals are great. You get all the job growth, the population growth, the income growth, all those things that we care about. However, I think that people are oftentimes way too tied to the metrics of a market versus where they can actually compete and where there's value. So, and I think those things can be different at some points, right? Where for me, and I'll get back to New Hampshire, but I guess I'm getting there in terms of the thought process. But I always want to buy in markets where I know that I can compete. Like, I'm not looking in Tampa, Florida, or Austin, Texas, or Phoenix, Arizona. Like, I can't compete there. There are local folks there who are running extremely efficient operations with very deep relationships with the people operating in those markets that I just can't compete with. So it literally doesn't make sense for me to spin my tires to try and find deals in those areas. So for me, when I went out of state, that was a huge criteria. And that's also why I buy up in New Hampshire, is I know that I can compete there. One, because I can physically drive there. Two, there's only really regional competition. The only competition I have in New Hampshire is folks in New Hampshire or people that are from Massachusetts, although now it is getting to be a little bit more competitive up there. And three, it's more of a mom and pop owner dominated sector of the business, or I should say market, where we focus. So up there's not a large inventory of large assets, which is why we look out of state. But there's a lot of 5 to 20 unit buildings, or, owners that own portfolios of 20, 30, 40 units, where they're just completely mismanaged, where rents are $700-800 when they should be $1,300, $1,400. So we can go direct to seller up there. We can gain traction doing that. We can find value up there. And yeah, it's not, nationally recognized as like this growth market like the Southeast or Southwest is, but I don't really care because I can get into deals at such a low basis that my risk adjusted returns are completely out of whack comparatively to going and paying market in one of these growing areas. So that's a big reason why we like New Hampshire. And we're also, we also have a nice portfolio up there. We're vertically integrated. We have a property management company up there where we manage our own deals, manage third party as well. But I think that so many people get caught up with the fundamental metrics, which matter, right, to an extent. You don't want to buy in like a declining area. New Hampshire still has positive population growth. It's not the same as it is down in Florida or Texas or, even a market like Indianapolis. But I don't care because I can go buy stuff at, 70 cents on the dollar. And that is always going to make sense. And no matter what market you're in, because you can refile your cash out in under a year. So for me, it's less competitive. I can compete more effectively there. And, it's my local market. So that's why I think it makes sense for me to keep buying up there.
Yeah, no, that's great. Like I remember 2.5, 3 years ago, I just reached out to every syndicator I could find that had a reputation on BP whenever I wanted to do my first deals in LP. And the returns obviously have been incredible. And this year, like in the last 6 months, I've noticed a lot of these guys are saying, hey, you'll get cash flow after month 12, or it'll be 2 to 3%, maybe 4% year one. It sounds like because you are taking this unique approach, not doing what every person under the sun is doing, you actually have, sounds like some better like cash on cash returns year one versus what some of these other guys are really starting to kick off right now. Is that right?
Yeah, absolutely. I mean, cash on cash returns, but also just from a risk adjusted perspective, it makes, for me personally, as an investor, I always think on a risk adjusted basis, because it makes sense to overpay or to pay market value for something that's in a market that's growing just because it's growing. Some people might say, yes, I tend to think, I don't know, I don't really want to do that. I'd rather buy something at 80% of market value at closing today, pay 800 grand for something that's worth $1 million, for example, and walk into equity, right? And have a buffer day one. And it's really hard to achieve a return like that in a lot of the core markets, despite them being what people consider to be the long-term growth markets. So sure, you could buy something like that. And if the market keeps doing what it's doing, you're probably going to do really well. And from a market perspective, your capital is pretty protected, but you're not walking into equity day one. Whereas up in a market like New Hampshire, I can go direct to seller. I can do all these different things. I can creatively structure deals. I can build deeper relationships because I'm competing with less buyers. And I can offer our limited partners, a 10% return on their equity the day that we close. So yeah, maybe, cash on cash return, we still do the value add thing, and cash on cash returns are a little bit lower in year one. We typically meet our preferred return, which is usually, 8, 9, 10% on most of our deals. And we'll still hit that in year one, because we'll raise the equity because we can, we can afford to raise a little bit more money because we're typically coming in at a discount. But from a risk adjusted perspective, the downside risk is significantly less, just because we're coming in and we're just fundamentally buying really good deals. So I think, without being too long-winded, I think that that's something that people should consider is market matters. I wouldn't buy in a bad market that's truly declining, but there's not enough folks doing deals in these secondary, tertiary markets where you can buy it just such a compelling cost basis that you're offering people returns the day you close. So that's why I like New Hampshire. And I mean, we have such deep roots up there now to where I can really build deal flow and compete up there and find really great deals, because it's just, it's not something that the whole country is looking for.
Yeah, no, that's great. And what's your portfolio at right now? Last I read, it's about 17 million. Is that correct? Or have you guys done more deals since then?
So we've done some more since then. I either personally own just myself with no partners, or I'm a GP in, 350 units or so right now, probably $30 million in real estate. We did a lot in 2021, probably about 150, 160 doors in 2021. So we kind of doubled our size in the last year. And those deals are a majority direct to seller, or most of it. I think we've only done 2 deals to date that are brokered. I mean, we still do a ton direct to seller. We have a full-time acquisitions guy salaried on payroll. We spend a lot of money on marketing. And again, that's how we feel like we can compete. I don't have the broker relationships that a guy who has been buying 100+ unit assets for the last 10 years and some great markets have. I'm working to develop those, but we can find these 40 to 90 unit deals, and we'll participate in some 100-unit deals, but we'll partner with these experienced operators. But we can find a lot of these mid-sized deals at really competitive pricing because we're just psychos about going direct to seller. I am such a deal junkie in terms of I'm so conservative on our buy that like the deals we do are just so compelling that it's a no-brainer for our LPs to participate, even though they might be in a market that's not one that they recognize. Like we did a lot in Lakeland, Florida last year. That's not really a nationally recognized market. It's 35 minutes from Orlando, 35 minutes from Tampa. It's in a really good area. It's a growing area, but it's not one that I'm competing with California buyers or New York buyers, like a market like Tampa or Orlando is, its surrounding areas. But the IRRs that we can offer on deals like that, it makes sense on a risk adjusted basis for our LPs to participate in some of those deals. So we're going deep on those types of deals here in the next year. And if we are going to do some larger stuff, it's likely, deals that we partner with other operators on that we have a longstanding relationship with.
Yeah, no, that's great. I have some friends that grew up in Lakeland, and I heard good things and bad things, but it seems like it's only done well over the last decade with the people I know who've been there. There's been a tremendous amount of growth.
Yeah, absolutely. It's a great city, great market for sure.
Well, nice. Well, what's the goal with you guys? Like, what are you looking to achieve over the next 3 to 5 years? It sounds like you want to build some deeper relationships, do some bigger partner deals, and get, even more vertically integrated and performing in New Hampshire. But what does the future look like?
Yeah, future is larger deals. We're going to keep doing our direct to seller transactions. For me, the ultimate goal in real estate is to own a large portfolio of real estate that I control. I think that's everyone's goal, right? So we're still going to keep going direct to seller for these 20 to 80 unit deals. In the next 3 to 5 years, I'd hope that we are doing more 100+ unit deals. And some of those middling deals that we find, I'm buying with myself or putting together simple JVs with a couple of investors, a couple of, long-standing investors that we have, and at least putting them together in a more simplified way. I would like to start doing larger deals in our target markets of Indianapolis, Central Florida, New Hampshire. We'll probably expand into a couple of other markets as we gain traction as well. We might start doing deals in Northern Florida. We're a co-GP partner in a deal in Texas and Houston. We might start trying to do more in Houston. But for me, if I'm going to put a number on it, I'd like us to be a GP on 3,000 units in the next 5 years. So we're at 300 now. And again, we doubled last year. We'll probably continue that trajectory over the next few years if the market agrees with us, if things keep going well, and if we're able to continue building our pipeline on the deal side. But as we start doing more deals, I want to work with more passive investors. That's really a big goal for me, is working with more limited partners. So I've had a lot of folks, reach out and ask me over the last year, what do you got going on? How can I participate? What does investing in your deals look like? From both people in my own personal network, my family, friends, and people that just see what I got going on online. I'm really active on Instagram and social media and LinkedIn and all that. So my big, audacious goal that I'd like to achieve over the next 5 years is to work with 1,000 passive investors, individual investors, help 1,000 folks get into real estate in some capacity, whether that's a $25,000 check or $100,000 check. So that's a big one for me, is to get people out of the retirement accounts in the stock market, because the folks that have participated in our deals in the last couple of years, we've done great things for them. And I just want to bring that to more folks.
That's great. Well, nice. Well, I'd like to shift a little bit into just what's going on, economically, what's impacting multifamily and just real estate investing as a whole. How have you viewed everything over the last, let's say, 6 to 12 months, just with developments?
Yeah, so I think when I look forward into 2022, and we're recording this mid-February 2022, I think the market will maintain its strength probably through the rest of this year. I think there's so much pent-up demand on the housing side, in terms of we're still at a housing shortage, and it's going to take continued development to really balance that supply and demand equilibrium out. I think that shortage in housing is going to be sufficient enough despite interest rates going up, which I think a lot of people tie into decreasing asset prices. And there is a correlation there for sure. But I think that's such a pent-up demand for housing, especially in the markets that we look in, which are typically supply constrained, because it's not profitable to build rental housing in a lot of the markets that we're in. Just the building costs are too high versus the rents they can charge on the back end, especially in these tertiary markets. I think that demand will stay there, and rents will stay pretty steady. And even if interest rates climb a little bit, maybe cap rates climb a bit, but it's not going to cause some massive shift in the overall commercial real estate market, at least as it relates to the markets that we buy in, which are secondary and tertiary multifamily, second and tertiary markets in multifamily. So that's kind of the first thought. But I do think that rising interest rates are going to have a significant effect on asset prices over the next couple of years as it relates to liquidity being removed from the market. I think when people think about the economy, they oftentimes think about, and I could go down a wild tangent here, so I'll try and keep it pretty short, but they think about, jobs, they think about income growth, they think about a lot of these higher level metrics, when in reality, and a lot of economists have talked about this recently, the overall economic strength of the country is oftentimes just related to access to credit and access to capital. When interest rates go down, availability of capital goes up. That pushes asset prices up because capital is being deployed into the market. When the interest rates, go up a little bit and access to capital becomes more expensive, access to credit becomes a little bit more expensive, that has a much more significant impact on asset prices than, small incremental uptick in unemployment, for example. And I mean, we saw this during COVID, right? Unemployment was going up. The economic output of the country was going down. And between stimulus and basically the federal funds rate being dropped to essentially zero, the access to capital was increased so significantly that asset prices were just skyrocketing. It had nothing to do with the economy. It had everything to do with access to credit. So I think that keeping an eye on that's going to be really, really important. I think, and I'm not going to, don't quote me on this, but I remember reading something recently about the last few times that the Fed has raised interest rates. Every time that they've done that, there has been a correlated reduction in the S&P 500, just in asset prices, right? And a reduction in the S&P 500 is oftentimes somewhat correlated with reduction in real estate prices or a pullback in real estate growth, because the two are very tied in a lot of ways. And every time the Fed has raised rates in the past, there's been a correlated decrease in the S&P 500, and they've done that in a slower time frame than what they're planning on raising rates at right now. So because the Fed dropped rates so low during COVID, they're trying to bump them up right now to combat inflation, to combat housing prices that are just running away from us. So they're going to do that in a faster pace than what they've done in the past, and they've done it a few times between 2010 and 2022. So I want to say, every time that they've done that in the last 10 to 12 years, and even before that out into the early 2000s, there has been a correlated reduction in the stock market, and therefore, some pullback and growth in real estate prices. And we're going to be doing it, or they've said they're going to be doing it in a much faster time frame this time around. So if we see a few rate hikes throughout this year, we should probably look historically at the data based on when they've done that before, and start to assume that the same thing's going to happen now. But I think that we're in a unique situation where there is such a housing shortage that's going to continue pushing rents a little bit, even if that does happen. But I think there's still a lot of multifamily development occurring right now. As that development continues, as those rates continue to rise, we're probably going to hit an equilibrium where I think the market is going to become a little bit more balanced. And, you're not going to be able to underwrite crazy rent growth or crazy price growth if you're on the single family side. So I definitely rambled there for a bit, but the short answer to your question is over the next 12 months, I think that, we're still relatively bullish, but into 2023, I mean, we're prepped for minimal rent growth, expense growth that equals rent growth, and cap rates that are going up. I mean, we're underwriting cap rate expansion on all of our deals much more significantly now than we have in the past. Most deals were underwriting, 0.2%, 20 basis points, or 25 basis points on an annual basis. So if we think that the cap rate in the market is 6 today, if we sell in 5 years, I'm probably underwriting a 7.25 exit cap, which is much more aggressive than what most syndicators and investors who are raising capital are underwriting. I see, 10 basis points a year, buy at a 5 and sell at a 5.5 in 5 years. But I just, I'm so obsessed with under promising, over delivering. The last thing I want to do is go to bed at night and be worried about what the market's going to do. So for me, we're a little bit more aggressive in that underwriting. So we're underwriting slightly lower rent growth, more cap rate expansion, and that's how we're dealing with a lot of the things that I just mentioned that I think might happen.
No, I tend to agree with you there. I think that's a good breakdown. Good deal. Now, as far as for you guys, like being focused on multifamily, have you entertained the idea of any other asset classes, or what keeps you laser focused on multifamily outside of the vertical integration, the focus of your firm currently, and just some of the things you've mentioned?
I mean, we've thought about getting into some other asset classes, mainly storage, just because I got a couple of close friends that are in storage. I've never really entertained RV parks, mobile home parks, office, retail, industrial, any of those sectors or asset classes. Um, but the reason that we haven't really done any deals or acted on that is I'm just the learning curve is pretty significant. I mean, it's a totally different business. And I think I'm late to the party. I still might be early to the party if I were to really dive into self-storage. I just don't know enough about that market and that business to want to do that. And we're fundamentally staying busy enough on the multifamily side that I haven't really had a need or a desire to change focus. Um, if there was a world in which we just could not find returns on the multifamily side, I guess we would probably shift our focus into another asset class. But I tend to look at the folks that are crushing it in that space and doing a lot of deals, going direct to seller, operating really well. And I'm like, it's just going to take me a year to even remotely get to the same level of knowledge as those guys. So I think if we were to make a change, we'd probably raise capital for a very experienced operator within that sector and just ride shotgun on a deal and learn, exactly what they're doing. But, we're finding deals on the multifamily side. And I tend to think multifamily is, again, from a risk adjusted return basis, I'd rather invest in a deal as an LP, and I always put myself in my investor's shoes. I'd rather invest in a multifamily deal in a secondary market in Florida at 17.5% projected IRR than a storage deal in the same market at 22%, plus IRR. Because for me, I can very easily conceptually understand the need for housing. Like that's very direct. There is storage being built in every single corner of America, it seems like. I mean, just my own personal experience. I do a lot of traveling. Every time I'm renting a car driving through any city, big or small, wherever in the US, I see storage being built. That's completely anecdotal, and I'm sure there's demand for it. I'm sure those guys are doing their research, but I would rather bet on a literal need, a human need, than one that's probably a human want, which is storage, right? So for me, risk adjusted basis, I can speak to it a little bit more effectively. We know how to operate our deals effectively and asset manage our deals really well. And I just haven't had the desire, I guess, is the easy answer to learn another, asset class within real estate.
Yeah, absolutely. Well, to kind of wrap up here, just going into the end, I would love to talk a bit more about creative deal structuring and scaling with private money. I think a lot of people understand like leveraging investor capital and bringing deals to LPs, but talk a little bit about how maybe you blend the two, private and investor capital, but also like what creative deal structures have been useful for you as a GP.
Yeah. So, I think there's a couple ways to go with this, right? I think you can put these strategies to use at the personal level for your own deals. And then you can kind of use some of these structures on a deal where you might be raising capital to better offer better returns, I should say, to your LPs. Some of the things that I've done on the personal side on deals as I grew my portfolio to help preserve the velocity of money and to do more deals in a shorter time frame was I did a lot of seller financing, did a lot of I offered a lot of second mortgages to investors, and I did a lot of second mortgage financing. And I did a lot with seller credits. So I'll dive into a couple of them. Really specifically, the two that I used a lot were seller credits combined with second mortgages. And we were going direct to seller and finding a lot of really good deals, and we still are, again, like I've mentioned. And when you're buying a deal day one below market, you have this built-in equity that allows you to leverage that deal a little bit more than if you're paying market for a deal, for example. So oftentimes, let's say to use this example again, we might be under contract for $800,000 on a property that's worth $1 million if we were to literally close on it and then go relist it that day before we do any value add spend or do any management or before we change management or anything like that. So if we're getting a loan of, for example, for round numbers, $600K on that $800,000 deal, that's really only 60% loan to value. So oftentimes there's room to bring in a second mortgage if you have capital in your network that's okay with investing in that at that level or in a position like that, which a lot of investors are. And so for example, in deals like that, maybe we'd have a first position at 600K. We'd have a conversation with the first position lender and say, hey, you cool with us bringing on a 100K note, 125K note as a second mortgage? And if they were okay with it, we would bring somebody in, a private lender, to invest in a second position mortgage, and we'd offer them 10, 11%, something like that, some fixed rate of return, maybe a point when we refi them out or sell the deal and pay them off. And still there's not significant over leverage of that deal. So for example, if we had a 600K first, 100K second, we only need to bring 100K to that deal. But we're still only at 70% true loan to value. So that's something that we did a lot of. And then I would combine that with seller credits oftentimes, and if I want to use the same example, maybe I put that $800,000 deal under contract at 900K, but with 100K back at closing from the seller. So the seller more or less nets the same. I mean, they have to pay a little bit more in transfer taxes and closing costs, but they're more or less netting the same. But I now am bringing 100K less to closing. So when I was doing deals early in my career, I was able to do multi-million-dollar deals with a fraction of my own money because I was leveraging these different strategies. So, and for example, in the example for 800K, let's say I bought it for 9 with 100K back, and again, have the conversation with the first position lender. Are you okay with this structure? And oftentimes, bridge lenders, private lenders, hard money lenders, they're going to be okay with some of these more unique structures where, maybe a government agency like Fannie Mae or Freddie Mac, won't be. So you have to work with the right lenders fundamentally. But again, maybe I'm getting a loan for 600K, or I'm getting a loan for, based on a 900K purchase price, maybe it's, 675 or something like that. And I got to bring, the balance to closing, but I'm reducing it by 100K. So I'm basically financing that incremental increase, but I'm getting that money back at closing. And oftentimes that allows you to bring less cash to deals, keep more money in your pocket, and just fundamentally do more deals. And, we've applied those strategies into deals that we've raised capital for, where, maybe it's a $3 million deal and we're raising, equity to buy that. Maybe we have to raise $1 million in equity, 30% roughly or whatever, to, with reserves, CapEx funds, all that stuff. And maybe we can structure that deal to where, we offer the guy 3.2 with a 200K credit, right? And we're still paying $3 million, but it reduces our equity raise a little bit. And therefore our investors that do invest have a higher rate of return, because we can finance more of the deal. We're bringing less to closing, all of these different things. So I think that there's, those are just a couple, with a quick explanation. But I think if you get creative, whether you're doing your own deals and you want to bring less of your own money, or you want to bring less of your investor capital and often in better returns, there's a lot that can be done there outside of just, buying a deal at market rate or just financing it in a traditional way.
I love that. That's awesome. Yeah, I think creative financing is going to be very important, just as rates potentially go up over the next year for people getting into the market. So that's a great breakdown.
Mm-hmm.
Well, nice. Well, share a little bit where people can find you, how they can reach you, like the best way to get in touch with you if they wanted to say hello.
Absolutely. So I'm really active on Instagram at Multifamily Wealth. So you can go and follow me on there, and post a lot of content. I host the Multifamily Wealth Podcast. If you search that on iTunes or Spotify, it'll pop up. And if you're interested in connecting with me, or getting on our email list to see our deals, or if you want to talk about passive investing, head to alignedrep.com. We have some great resources that talk about passive investing on our website, and you can quickly fill out a contact form, get a download, and we can connect through there. So any of those ways is great, I would say. And if you do just want to email me directly, axel@alignedrep.com.
Great. Well, I appreciate it, Axel. Thanks for joining us today and sharing with everyone.
Absolutely. Thanks for having me, man. This has been great.
All right. Talk soon.